A busy week of earnings is drawing to an end, and today we want to cover e.l.f. Beauty that is down a massive 25% after they reported their earnings after the market closed yesterday. They're in fact down nearly 50% just over the last 12 months, and when this company does open today, it will be starting at a new 52-week low. So is this one we should be buying? Why are the reasons this company is dropping quite significantly? We're going to do a deep dive as well as get to our own valuation towards the end of the episode. So the headline does give it away. The company stock in fact tanks after they cut their guidance, and they do largely put this on being a soft January, where they also add that the TikTok saga as well as the LA wildfires did have an effect on their numbers. So let's take a look, let's see what the actual numbers were first before we get into some of their reasonings. And we can in fact see here, they did come shy, although only 1 cent in the EPS, 74, market wanted 75. Revenue, they did come above 355 versus the 330, but the main reason for this large drop, as we can see here, is they cut their full year guidance after seeing a whopping 36% drop in their profit, and as we can see here, a softer than expected sales trend in January, marking a rare downturn for one of the beauty's hottest brands. Now if we take a look at their bottom line, another miss for this company, where in fact they did report 17.3 million. That is significantly lower than the same quarter last year, where they reported 26.9 million. Having said that, whilst they did miss on the EPS, their sales are still fairly strong, up 31%, but as we can see, with guidance being cut, EPS being missed, this company has taken a hammering. Bear in mind, there is only 1 quarter of their fiscal year remaining, but they have given the guidance, and now they expect between 1.3 to 1.31 billion, lower than the estimates of Wall Street at 1.34 billion, but they've also cut their previous guidance, which was a little bit higher. So we have a company here that's missed on their earnings per share. Their bottom line is significantly lower than the same quarter last year, and they've also cut their full year guidance. In fact, not only lower than Wall Street, but also lower than their previous expectations. It doesn't stop there, because we also see the same narrative for their earnings per share. They see somewhere between 3.27 and 3.32, which is again the same story as their revenue, significantly lower than the 354, which again, same story, significantly lower than the 354 the market wanted, but also lower than what they had previously guided for. So both revenue and essentially the EPS getting hit for the full year guidance. And we also note here the implied guidance for Q4 looks even worse, with EPS target around 66 to 71 cents, far below the market expectations of 97. Now, as we said, overall it isn't looking too great, and when the CEO did speak about this, the results, he also pointed to 2 maybe unusual areas that you wouldn't think would affect this company. He said the LA wildfires, people I don't think want to be tone deaf with posting a lot of things about the devastation that went on, and a lot of uncertainty around TikTok. Now the reason why he points to this as issues, because he talks a lot about social commentary, and that he believes a lot of sales are essentially driven by social media, and with fewer people talking about beauty online, this in turn will lead to lower cosmetic sales. Let me know if this is something you do believe can have effect on their sales, but ultimately they have missed on the bottom line. Their top line revenue was in fact fairly strong, so quite an interesting narrative to be talking about. We can also see the considerations of potential new tariffs against China, and they have about 80% of their supply chain in that region. Definitely a factor we seriously need to consider, especially when we come to our valuation, our margin of safety. And the CEO has mentioned here that it is too early to say whether or not they will raise their prices, which in turn could in fact lower their revenue depending on the price elasticity with the consumers. And we can see though they do believe that the 10% duties are a lot better than what the company was initially expecting. And bear in mind, this is one of the fastest growing brands in the beauty region, and that the growth is starting to ultimately slow down. Now looking at the company's earnings, we can see over the last 4 quarters they have outperformed on 3 of them. However, the most notable one was that quarter just gone where they did have a miss, so they have a 75% track record. And looking forwards, they are still anticipating growth 3 of the next 4 quarters at double digit in comparison to the EPS on a year on year. But one thing we do want to point out here is, based on the EPS target of March 2026, the forward PE now sits at just below 21. Having said that though, when we do take a look and compare that against others in the sector, they do trade a lot lower, around 16 on a forward PE. Hence right now, even with the drop, maybe not as high of a premium, but this company still trades significantly higher. One thing we would say though, when we do compare it to their 5-year average, Elf Beauty is trading significantly lower. Now also bear in mind, this is a company that has historically been a very strong growth company. They do get the A because ultimately year on year, their growth 59% is above the sector comparative, as well as the last 5 years at 34%. And the same to be said moving forwards, they do still anticipate a lot of growth, 39% above both comparatives at 2 and 21% respectively, and the earnings per share expected over the next 3 to 5 years to grow at 21% above the sector comparative at 7.5, but a little bit lower than what they have been used to over the last 5 years at 23%. When we talk about the profitability of this company, they get a C rating. Gross margin, very impressive, 71% above 36 and 67% of the two comparatives. And the bottom line of 9% is above, again, 4.26 as well as 7%. We also want to draw your attention to their cash from operations, which is actually a little bit lackluster, not something we do say typically on this metric for companies, but 32 million is below both sector comparative at 841 million and also below the 50 million from what they have seen over the last 5 years. Now we also want to flag a couple of their investor presentation slides just to get a deeper understanding of their earnings. The first one in terms of their results. In comparison to the same quarter last year, revenue is up 31%, but we also see their market share increasing. That is something that maybe you don't get from financial information, but we can see up 220 basis points. Then when we take a look at some of their non-financial information, they now have 24 consecutive quarters of net sales and market share growing. They are only one of 6 consumer companies, bear in mind, out of 546 that have grown over the last 24 quarters at least 20% quarter on quarter, and they are the only cosmetic brand out of 988 to have gained market share again over the last 24 quarters. That is consecutively. Very impressive, still looking very strong in terms of the overall growth. And then we take a look at some of the key highlights. Now bear in mind, FY25 for them, we are into quarter 3, so just waiting for their next Q4 results. But they are up 40% year to date, which is very strong. They are still gaining market share, as we have discussed. However, the main drawback for this company is that consumption is softer than expected, hence why we did get the cut on the guidance, both revenue as well as their earnings per share. In terms of their outlook now for the second half, they still expect growth, although a massive slowdown between 14 to 16%. And when we take a look at this company, they do have presence in 15 countries. They are a very large brand, and as we said, one of the fastest growing. If we take a look at one of the reasons why this company has been able to grow at such a strong rate, not only are their margins very high, but just a quick comparison against other products, they are very cheap in comparison, not in isolation, but if you just take a look at one product, $12 versus $38, it is very impressive to see that consumers are buying their products which do have a very high margin, which is helping drive both top line and bottom line, although we have noted some slowdown. We also see here, this is just taken from their slides, so we have to take the information as factual, that they are the number one most purchased from Gen Z, from millennials, and also Gen Alpha. So they are doing a lot of market penetration, and as we saw in a previous slide, market share only continues to increase on a consecutive basis. In terms of this latest quarter as well, their gross margin is very strong at 71%. That is plus 40 basis points from the same quarter last year. And when we take a look at their EBITDA, again up 16%, we are seeing a lot of double-digit growth. However, one thing that is a little bit lackluster is when we compare their bottom line and earnings per share to the same quarter last year, it comes in line. 43 million for net income both quarters, and the same to be said for the earnings per share. Ultimately, if a company is increasing its top line revenue consecutively, you do anticipate the bottom line and the earnings per share to follow suit, not something we have seen. Now, what do they expect for the full year? Still 27 to 28% growth, although they are expecting a slowdown in the next quarter. Again, we saw analysts didn't like to see that, and as we can see, they are anticipating a slowdown at the second half, which one quarter they have just reported. In terms of the full year though, gross margin does look promising with the growth of 40 basis points. And we want to just point out one consideration they have had with the new tariffs that have been discussed. They believe it will not impact their fiscal 2025 numbers. With the fiscal 2026, we will hear more about this in May to understand how much of the effect it will have on their revenue, how much they believe they'll need to increase the prices, which in turn may lower their demand. And for the full year EBITDA, we can see estimated 23 to 25% growth. Now, what are the institutions doing? We do notice 92% ownership with around 1 billion worth of sales over the last year. However, during the same time frame, we see triple the amount of buying, so they are very bullish. We also notice quite a significant number of buys in Q4, so interesting to see what the institutions will now do given the massive drop we have seen in the share price, given the cut in guidance, revenue and EPS. And with regards to insider ownership, it does sit at 3.5% with around 56 million worth of sales just over the last year, although no movement in Q1, and in Q4 we do get a very small amount of sales. As always though, we will show you for full transparency who these insiders are, but bear in mind we don't really consider this in our own investment thesis, as we do believe insider selling, not bearish, they sell for many reasons, personal and financial. Now let's just quickly cover the underlying metrics before we jump into our own valuation. But the free cash flow, we do notice here it is very inconsistent on a year-on-year basis, but we do anticipate over the next 12 months it to nearly triple. And then we move on to the sales growth, very nice to see here on a percentage format. Ultimately they have been growing significantly from 2020, but as we have heard, the growth story is looking like it is coming to an end, but we are still noticing double-digit increases, which is still positive to see. Total sales, well, they reported 190 million in 2015, latest annual accounts 1.02 billion, and we also want to let you know they have been diluting your position as a shareholder over the last 10 years. Typically, we say we don't mind if they can outperform the S&P, because ultimately what we want to see here are share buybacks where companies are returning excess cash to investor pockets. ROIC, we want a minimum of 10% or more to give us faith management are able to effectively allocate their capital, something we've seen over the last 2 years and on a trailing 12-month, maybe something to keep a closer eye on. But whilst we have been praising their gross margins, we even saw it against the sector median and the last 5 years, we do notice both operating and free cash flow are a little bit inconsistent, so maybe something to factor in when we do get to our margin of safety. Net debt to EBITDA, the final metric, these are the number of years it would take the company to pay off all of their debt net of cash on hand. We want a maximum of 3 because this ultimately does tell us how strong the balance sheet is, and given it's been decreasing, a great sign. 0.8 on a trailing 12 month, expected to go lower over the next 12. This signals to us balance sheet looking very strong, which is really something we want to see from all the companies we do consider as an investment. We just want to let you know we have released our latest free weekly article. We drop one to your inbox every single Monday morning for free, where we highlight severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year. On top of that, you can grab a copy of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. We then move on to the intrinsic value. In today's episode, we get to $86 derived from the DCF model. Now we will show you how we got to that. We have the free cash flow year on year. Now we have had to lower the growth rates given the growth story that we had assumed was going to continue is looking like it is starting to slow down, but bear in mind these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Elf Beauty or any others. But based on 15% and a discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $82, which does imply around 24% upside. Now, for those that believe that is way too optimistic, at the 10% point, we'll show you for transparency, just under $60, which implies a downside of 11%. And for those that are a lot more bullish, at 20%, intrinsically $113, which is upside of 69%. Now, we will take through the median rate in today's episode to be on the more conservative side, and we're not done yet as we do like to apply a margin of safety, starting off at 10%, executing on it if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at around $74, then we keep going till it's near the current trading price. And what we're ultimately saying, around the $66 mark, we see this at a 20% margin of safety. Wall Street themselves see upside of 58%. They see this at $105 at the end of the year after cutting their price target. So previously it was significantly higher. Now they've lowered it, still 58%, could be one to consider. And bear in mind, this margin of safety at 20% is based on the growth rate of 15% moving forwards, but for those that just want to see at the upper end at 20%, you would ultimately get a higher MOS. So if we show you what that margin of safety would be, at 10% a buy at 101, and as we keep going at the higher rate, clearly you will get a larger margin of safety, which in today's episode would be at 40%. But give us your thoughts. What do you believe in terms of the growth rate moving forwards? Is this one that is a strong buy after this drop, or in fact has the earnings guidance cut put you off? As always, give us your thoughts. Don't forget to sign up to the free weekly newsletter below. Grab those spreadsheets. Come and join us in the Patreon where we do cover our weekly buys and sells. There's been a lot of volatility, so we have made purchases as well as sells. And as always, have a great day. We'll see you all on the next one.